Check your 401k. You now own SpaceX without choosing it. Without agreeing to the price, millions of investors became SpaceX owners without ever clicking buy. When SpaceX joined the index, the buying wasn't optional, it was automatic. But the stock fell after its IPO debut, continuing a sell-off. Forced demand was supposed to push the price up, but it didn't. You never picked it. And it still fell. A small committee of people you've never heard of just decided that your retirement savings should buy SpaceX. Your retirement savings at Vanguard? They had no choice. They bought SpaceX at any price. The fund doesn't ask if the price is fair. It just buys. The machine creates demand. But demand is not value. Artificial demand can hide weakness. A rising price can still cover a bleeding business. Forced buyers can create demand. They cannot create conviction. But demand alone does not answer the real question: what is it worth? On inclusion day, passive fund money was set to buy SpaceX. Traders expected a pop. Optimism filled the floor. But instead of rising, the stock fell. That is the alarm bell. Forced demand showed up, and the price still broke. The market can signal this price is too high, even with forced buyers. Forced demand is powerful. But if it cannot hold the price, what did your fund really buy? SpaceX is called revolutionary, but its financials tell a different story. It generates billions in revenue, but remains deeply unprofitable. AI losses alone outweigh Starlink profits, pushing SpaceX into the red. Investors are paying for future profits that may never materialize at this scale. The stock's high price assumes these losses will turn into massive profits. That's a bet. Innovation is real. But it doesn't justify any price. Profits matter. If profits don't back the price, what does? When passive funds buy SpaceX, some analysts suggest insiders and early investors may be selling. The fees keep flowing, whether the stock rises or falls. Not every fund holds it, but if yours does, the risk is yours. You didn't choose to buy SpaceX, but you're holding the bag if the price falls. The forced buying machine benefits those who sell and those who collect fees, but the risk lands on ordinary investors. So who really benefits from index inclusion? And who pays the price? Index funds are marketed as safe, diversified investments, but when a stock like SpaceX is added, every fund tracking the index must buy it. You bought diversification. The index slipped a giant bet into the basket. You didn't choose the bet, but if it breaks, your account feels it. If that price snaps back to earth, your retirement account takes the punch. The very tool you trust for safety can become a vehicle for hidden risk. If forced buying can't prop up a stock forever, what does that mean for the safety of the index funds we trust with our savings? You can own SpaceX without choosing it. Forced demand does not guarantee a good price. So next time a hot stock joins an index, ask yourself, am I investing or just being bought along?